Hello, this recording is going to look at direct materials and we'll consider how we value our inventory of materials and the materials that are used within production. There are three methods of valuation that we will consider: FIFO, which is first in, first out; LIFO, which is last in, first out; and AVCO, which is the average cost method. So it is important that we can put a value to our inventory so that at any one time not only can we determine how much inventory we have, but also the valuation of that inventory. We are going to look at recording these figures manually, whereas the majority of companies will use a computerized system, and electronic devices such as barcode readers would allow those organizations to update their records. So we need to know the value of our stock or our inventory, and we need to know the value of our issues. This is required not only for management accounting, but also for financial accounting. You may already be aware that there is an inventory valuation appearing within the final accounts. So, the three methods that we look at, which are all methods of valuing our inventory, are FIFO, LIFO, and AVCO. It's important to remember that the actual physical movement of the inventory in the warehouse may not exactly reflect the way in which we are going to value it. So if we look firstly at FIFO, or first in, first out, using this method, our issues are priced at the price of the oldest batch in the inventory. So that's the oldest material in stock we use first. With LIFO, last in, first out, then inventory issues are priced at the price of the newest batch in inventory. So in other words, we use our latest deliveries first. And then AVCO, or average cost, we calculate the issue price after each receipt of inventory, taking into account both quantity and value. Now, for both FIFO and LIFO, important to remember that the physical inventory movement may not reflect the valuation. So although we're valuing our inventory based on the fact that the first items that came into stock are the first items that we're going to issue, in reality what happens within the warehouse may not reflect that. So although the store's ledger card says we're issuing the oldest items, what the warehouse staff actually take out of the warehouse may not necessarily be the oldest items. So we're going to have a look at an example of these three methods before we move on to the store's ledger card. So in this example, Sid makes the following purchases for resale. On the 10th of January, he buys 50 units and he pays £1 a unit for those. 20th of January, he buys another 60, at which point the price has gone up to £1.10. And on the 30th of January, he buys another 40 and the price has gone up again to £1.25. So in total, Sid have 150 of these units in stock, and the total amount that he has paid for these units is £166. On the 31st of January, Sid sells 60 of these units and he sells them for £1.50 each. So his sales revenue 60 units at £1.50 is £90. So he will receive £90 for those 60 units. But how much profit has he made on those units that he sold? Well, that depends upon the cost of those units. So we need to determine which units did he sell. So those 60 units, if we are to use FIFO, first in, first out, then we would say that those 60 units sold by Sid consist of the 50 units that he paid £1 for, because those were the first ones he received, and then 10 from his second delivery that he paid £1.10 for. And we can see that down here. 50 units at £1 is £50, and then 10 units from that second delivery where the price had gone up to £1.10. So that gives us £11. So in total, the units he sold cost him £61. So if he sold them for 90 and they cost him 61, then the difference would indicate that he'd made £29 profit. In addition, he had £166 worth of inventory. He has sold £61 worth of inventory, which means he has £105 of inventory left. So he's made a profit of 29, and he has a closing inventory valued at 105. That's using FIFO. If instead he used LIFO, then LIFO means last in, first out. So those 60 units that he sold would be the last 40 units that came in at £1.25, and then 20 units from the delivery before that when it was £1.10. So we can see, if we scroll on down to the LIFO, here we have that one. So 40 units at £1.25, 20 units at £1.10. So in terms of profit, remember he sold them for £90. Using LIFO, they cost him £72. So his profit now would be £18. And in terms of what he has left in stock, he originally started with £166 worth of stock. He has sold £72 worth, and so he's got £94 of stock left. So if we just scroll back up and look at the FIFO figures, profit under FIFO 29 and closing inventory 105. Whereas if we use LIFO, we've got a different profit, 18, and a closing inventory of 94. So the two different methods has given us different profit figures and different inventory valuations. If we now look at the third method, which is AVCO, so we just go back up to the example. AVCO works on an average cost, and it's actually a weighted average. So we look at the total cost of our inventory, which is £166, and we look at how many units we have in total, which is 150, and we work out the average cost per unit, £166 divided by 150 units. So here we have this one, £166 divided by 150 units means we have an average price of 1.107. So 60 units at 1.107 gives us a cost of £66.40. So if he sold those 60 units for £90, and we're saying they cost £66.40, then using this method we have a profit of £23.60. And in terms of his closing inventory, he had £166 worth of inventory. He has sold £66.40, therefore his closing inventory £99.60. So again, we have different figures. So depending upon which method we use, we will have different profit figures and different closing inventory valuations. And way to which remember the effect that these different methods have. FIFO gives us the highest profit and closing inventory valuation, then AVCO, and then LIFO. So LIFO will give us the lowest profit and closing inventory valuation. And if we just look back at our figures, just to prove that that's true. So if we look at our profit, FIFO £29, LIFO £18, AVCO £23.60. So FIFO was the highest, LIFO was the lowest, AVCO was in the middle. And the same with the closing inventory. 105 with FIFO, 94 with LIFO, 99 with AVCO. So again, AVCO is in the middle. So here on this diagram we have an arrow, and if you look at the letters F, A, L, fall. FAL spells fall. So profit are falling, closing inventory valuation are falling. So with FIFO they're the highest, falling to AVCO, falling to LIFO. Now this only happens when we have rising prices. So what do we mean by rising prices? So let's go back up to our example. Each transaction that has taken place has resulted in a higher price being paid for the units. £1, £1.10, £1.25. So when we say in times of rising prices, that is what we are actually referring to, the price that we are paying to purchase our items. So there we have the effects that the three different methods have on profits and closing inventory valuations. So highest profit, highest closing inventory with FIFO, then AVCO, then LIFO in times of rising prices. So that's just an introduction to the three methods and the effects that they have. There is another video which will now look at how we actually record these movements of stock or inventory into and out of the organisation on what are referred to as stores ledger cards.